All right, everybody, welcome to another edition of Think with a Drink. This is the weekly webinar series brought to you by the ARIES Foundation for Financial Education. And this week's topic, we are doing types of life insurance explained. And what we mean by that is there's a whole slew of different types of life insurance out there. And it gets a little confusing sometimes, a little daunting for people. And all we want to do is break it down, try to make it easy to understand and grasp what each of them does, good, bad about them, and maybe who would be most appropriate for those types of insurance. Before we get started, just a little quick housekeeping. Just know we are recording this event. The event is being shared on our YouTube channel. It gets shared on our website. So just ask that you keep your microphones muted. You don't have to worry about the cameras because the only thing that's being shown is what's being presented on the screen. However, there is a chat box. So if you do have questions, please type them into the chat box. And that way, my co-pilot, who I'll introduce in a second, will be there to sort of, field those questions, throw them out to see if there's something that we need from the general audience to answer, and also to try to keep me on pace as I am flying this unwieldy machine here. All right, so your pilots, your presenters for tonight. My name is Tom Alessi. I am the president of the ARIES Foundation. I have been in financial services now into my 24th year. I'm an investment advisor. That means that I act as a fiduciary whenever giving guidance or advice to any of my clients. I want to introduce my vice president, Craig. Why don't you introduce yourself?
Sure. So I'm Craig Richardson, vice president of the ARIES Foundation. I've been in financial services a little over 18 years now, and my specialty is working with families to help them define their financial goals and have a better future with their money.
And Craig will be joining us as we go along this evening. Like I said, he's also there in case some questions pop into the chat box. Try to keep this flight on time as we move along here. We did tell you that Think with a Drink is brought to you by the ARIES Foundation for Financial Education. You can visit us at www.ariesfoundation.org. We are a nonprofit whose mission is dedicated to the idea or concept of trying to help everyone have a better relationship with their money. Because whether you realize it or not, you are in a relationship with money. And just like every other personal relationship that you have in your life, there are triggers and emotional behaviors that occur that cause us to act irrationally sometimes when we're dealing with our finances. All myself, Craig, the rest of the ARIES team tries to do is try to help everybody take a little step back and take some of that emotion out of the equation. These are just way too many words on the screen, Craig, for me to do. So just understand, we're a nonprofit. This presentation is meant to be educational. We share it on our YouTube channel. We share it on our website, like we said. All we ask is that if you are going to do that, that you share it in an educational manner as well. Myself, Craig, the rest of the ARIES team, however, does say that if you do ever have any questions, whether they be legal, tax, or financial, that you seek out the help of a professional to get those questions answered. Okay, we got through that part. Now we get to the fun part of the evening, which is, hey, we call this Think with a Drink. And the reason for that is we understand that sometimes financial information, some of this stuff gets a little unwieldy, gets a little, daunting for some people, and they're challenged by it. And so all we try to do with Think with a Drink is make it more relatable, put it in a casual and more relaxed atmosphere. And we can't think of a better way to do that than as if we have something to sip on as we're going along. And for this evening, I have chosen, this is Ship Shape. This is a Czech-style Pilsner from our friends at Treehouse Brewing. If you don't know the story behind Treehouse, they're out in Charlton, but they have a couple of ones in Deerfield and another one they just opened on the Cape. that if you ever get a chance to stop by, you have to stop by because the beer is phenomenal and the amount of taps that they have is great in terms of the beer that's available. But Shipshape is a Czech Pilsner.
Hmm.
Done with Bohemian, in the style, which is, Bohemian malts and Saaz, that's SAAZ hops, right? So, certainly a very, very drinkable beer on a hot day. And of course, going into more hot weather, it's going to get humid as we go here through the rest of the week. But one of the things was we talked about this before with some ideas on pairings, which I think we want to add in a little bit here as we do this. So if you're ever out and you're ordering like nachos or pulled pork, or even better, pulled pork nachos type of thing, right? That's
Yes.
perfect pairing for a Czech style Pilsner, right?
Definitely
So,
upscale pairing of beer and pork nachos. I like it.
yes, well, it's a very good one for it. So if I'm never going to get too high class with you. Let's face that, right? So pulled pork nachos is as high as we're going.
What's
What
the
do you
best
got this
wine?
evening, Greg? What are you drinking?
I'm actually going Treehouse as well, and I'm drinking Juice Machine.
Oh, so that's out of the Julius line there in
It
terms
absolutely
of
is, yeah, with unforgiving flavors of mango and orange. And it's really cool is they have the robot on the label from Lost in Space, right?
okay. I can't see it that well, but are we sure that's not the Jetsons?
It's not the Jetsons. That's Rosie. That's the maid. This is that one of those first robots from the 60s with the globe head and the two black arms.
Oh yeah, yeah. Dr. Smith, warning, warning.
Yes, 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 that one. Yep.
Oh, interesting. Very nice. Well, here's the skull.
Oh, oh, very citrusy. You would not like it. I like
I'm
it.
trying to pick up with you do get a little bit of that, let's call it doughy flavor with the see. That's why it would sort of pair with that. That's why you want that spice, that cheese to go there. That's where the nachos come into play with that.
I thought you said last week's beer tasted doughy too. Are you sure you're not just eating dough before you come on?
Well, I don't remember now I don't remember what I was drinking last week. I was drinking Surfcaster last week. So in a similar line of malts and hops type of thing.
Gotcha.
So I think that's just a different version of the Pilsner. This is more of a Czech style Pilsner.
This one's good. This is smooth though. It's a double IPA. So
Well, there you go. You may not make it to the end of this flight.
I might not. I think it's like 8.6 or something like that. 8.2. Right. Yeah.
Good thing you're not driving anywhere. All right. So our agenda for this evening, different types of life insurance. We'll go through each one of them. Group and supplemental life, because that's a little bit different. We'll talk how that sort of, goes along with this and is part of it. The questions that we get on life insurance more often and regularly, and an offer from us. ARIES has something that we want to offer to everybody or anybody who listens in terms of this. So before we begin, like we did last week, we just, a little bit of, what's something that you're feeling good about, or, that's making you, with feeling with that good vibe out there. So Craig, what do you guys started last week? You start this week.
Well, last week I started with that my girls are going to college, so I can't use that again this week. So it would be, I think I'm walking upright today. I had a very bad back issue yesterday, and I'm feeling much better today. So,
well, you're above ground, so there's the first start, right? So you're above ground. That's a good thing, and now you're walking upright. So.
Yeah, I don't think it was going to kill me, but I hoped it would, and then now it's better though. So.
That's good to hear. Well, glad to hear that you're at least getting around better. I know you were struggling yesterday in terms of dealing with that. So yeah, there's a reason to feel good. Mine is it's my anniversary tomorrow. So
happy anniversary.
Yes, my anniversary is 27 years tomorrow with my wife. So we've been happily married and still love each other. And that's always a good thing to be thankful for. As anybody knows the adage, happy wife, happy life.
Absolutely. Give that woman a medal.
Yeah. Believe me, I think about that every single day. Absolutely deserves one. That is true. All right, let's get into this now. So the first thing we're going to kick it off with is term insurance, right? So term insurance, for as basic as you can get with term insurance, is that term insurance the idea behind it, it is covering you for a period of time from point A to point B. And that term can be anywhere from 1 year to 30 years. I know there are some providers out there that go to 40, but they're very, it depends on age, and there's not too many. It's tough to find of that 40-year. Most term policies, Craig, that we run into are usually 20 or 30 years, right?
Yeah, usually the max is 30 years. And you're right, common term, anything from 1 out to 30, and usually in 5-year in periods.
Correct.
15.
Yeah.
Mm-hmm.
And even today, right? The flip side of that, he mentioned that the 1 year thing. It's what's known as annual renewable term. That's ART. Again, that's another one. It's not that common to find anymore.
No, and for a good reason. I mean, part of the issue with 1 year term is that it increases a little bit every year for the same amount of coverage.
Right.
So wasn't as didn't stay that popular when you can lock in a rate for a given period of time.
Yeah. That's the idea behind it. So like that, what term does is it covers you for that period of time. It's very inexpensive, and it builds up no cash value. Essentially, that if you live from point A to point B, the insurance company keeps all your money. What you had for this was peace of mind. Term insurance should be thought of like homeowners or car insurance. I mean, even more so, because you never want to have to use this, because if you use this, that means you're dead.
Yeah, I mean, the really nice thing about term insurance, especially if you're younger, starting a family, and you have a lot of liability, right? So a lot of people in your home are dependent on your income and you being there and producing. And all of a sudden you're not. You might have, like I said, a large liability, because liability is going to be, base cost of, what your value is as far as production value, human life value.
Right.
It's not about what you're worth to other people. It's about what kind of much income would you have generated should you have been alive, right? And if you're young, your human life value is high because you have potential to earn a lot more money over that time period.
Right, because it's your whole working career, essentially, is what you end up there with.
Right. Well, it can get very expensive, and we'll talk about other types of insurance. With other types of insurance, well, term allows you to cover a lot of liability for a very small dollar.
Right. And one of the real reasons behind that is because of all the death claims that get paid out in the insurance world, less than 2% of them get paid by term insurance.
That's correct.
So if you really take a look at this, and not to really, doom and gloom too much on it, but the idea is, if they underwrite you or some company says we're going to cover you for 20 years, the likelihood is you're going to live for 20 years.
Oh, I don't think that's doom and gloom. I think of that as a positive. You get a free medical exam, and if you get qualified, you're absolutely going to live for the term.
You're going to live for the term. But then at the end of the term, guess what? They've kept all your money. You don't have any more insurance, and hoo-hoo, you're alive. That's it. It's one of the reasons that you hear the ads for on TV and radio, and those financial entertainers, Susie and Dave. They're all doing it because they know they're not going to pay out the death benefit.
Right.
They've got all the tools and calculators and actuarial tables and guys who get paid just to go through this and determine it. So, as Craig said, if you're looking at this from who would benefit the most from taking out a term policy, as Craig said, young families looking to cover debt obligations, liabilities, and hey, what happens out into the future?
Yeah, and sometimes too, let's say you're taking out a business loan to do a startup. Sometimes banks will make you take out a term policy to kind of secure the loan, right? Because if you die in the middle of it, they get some kind of payback.
Correct.
So there's lots of reasons to have term. It's also a great placeholder. It allows you to buy a lot of insurance while you're young and healthy, which, we all get older every year. And usually as we get older, we don't get healthier.
Right. Right. Like we say, there are steps you can make. If you're a smoker, you can stop smoking. If you overeat, you can cut back on your eating. You can start exercising, things you can do to try to get healthier, but you can never get younger.
Well, not yet, not till they invent the time machine, but yes, other than that. But the other thing too is, we also will talk about term insurance as being like renting versus buying the house.
Right.
sometimes you want to look at what kind of riders of term insurance, or these are extra benefits they'll give you that can make, maybe turning the term insurance from renting to with an option to buy, right?
Right, they are renting to own type of thing.
Renting to own type thing, right? So it's convertible to other things.
Yeah,
Sometimes also you can get riders that includes like disability coverage that are built in.
right.
That allows you. So there's lots of reasons to, the term is not an evil thing, but it's
Yeah, no. I mean, it just depends on what you're trying to do.
the right tool for the right job. Exactly.
Yeah. All right, so moving on to, at least I think this is where I'm moving to. Yeah, so now we move into the categories of what, now that's term, which again is just covering you from A to B type of thing. Now we move into permanent insurance. So permanent life insurance works differently because, let's face it, I understand most of us think we are Superman or immortal or vampires or whatever, but we're all going to die at some point. So having permanent insurance means that it's going to be there so long as the premiums are paid when you die. So it becomes more expensive than term just on the idea that they know they're going to pay the death claim.
Yeah, and actually permanent insurance is really good for those people who aren't going to die. And the reason for that is because it actually endows at a certain point in time.
Right.
So if you want to beat the life insurance by living past the age of 100 or 121, whatever the whole life, the permanent insurance is based on, then you get the face value in cash. So
Right.
the goal, live to be 120 so you can get the insurance company.
Live a really, really long time. So let's start with the basic, right? So this is what is known as universal life. Okay. So the way universal life works is you pay a premium to the life insurance company. The life insurance company then deducts what they call the cost of insurance from that premium. They then take from that any other expenses that go along with the cost of the policy, and they credit you usually an interest rate or a dividend payment type of thing on an annual basis. It's permanent, so it's going to be more expensive than term insurance. It, however, is going to build up cash value for you. So cash value that can be used to do other things, such as offset future premiums, be used to pay for something else, etc. The cash is yours that you can do.
Yeah, and I'd be, I don't know if I would call it more expensive. I would say the premiums you're paying up front are higher, but over time, permanent coverage can actually be less expensive than temporary coverage.
Well, you're talking about the annual, but I'm just talking about when we initially look at, when somebody looks at a premium and, the term coverage is $100 and the permanent coverage is, $500.
Right. It can be more affordable. It's not necessarily cheaper.
Correct. Right. No. So, so what Universal Life does is there's two different versions of all of the Universal Life because we'll have more policies that come off this chassis. But basically, you can do one of two things with the death benefit. You can have the death benefit stay static. It means, like, say it was $100,000. That means the policy is always going to pay $100,000 regardless of what happens. Or you can have it be the death benefit plus whatever the cash value is accruing to. So now you have $100,000, and if in 20 years there's 25,000 in there, the policy death benefit would now be 125,000.
Mhm.
Here's what happens with that. The problem is that cost of insurance, like Craig talked about, with that annual renewable term increasing every year. That's what happens in this policy. When Universal Life looks at the cost of insurance, they're going to look at what age you are every year. And they're going to look about how much they're on the hook for in terms of coverage of the death benefit. So if you don't have a static death benefit, if you're trying to cover the cash value at the same time, that means in the scenario we talked about, you're always got $100,000 of death benefit. It's going to get more expensive out over time. And it's going to eat away at the cash value that's growing in the policy.
Right. Yeah. And it's another one of those things where you just want to be reading the small print. because what is the cost of insurance increase going to be on an annual basis? What guarantees are there based on the crediting? Usually with UL policies, there aren't a guarantee on the crediting. And also expenses, while they may start low, they may have a cap that may be far higher than you would anticipate. So
Right.
it also becomes something that it gets variable. The only reason we say that is I've seen these types of policies actually implode on people, where they actually have to dump more cash than expected into them to keep them.
Oh yeah. Yeah, no. I mean, that's what it's part of that. So there's some of that you've got, like Craig said. So it's more of, as somebody is going through this with you, or you're looking at one of these policies, you just want to understand all of those fees and charges and expenses, and not so much, hey, what it's going to mean in the first 5 years, but what it's going to mean maybe out in the, 20 or 25 years out, and what that can do to the policy. Because, as Craig said, these things can cannibalize themselves, and you could literally be paying more than what the actual value into the policy is, which means it's eating away at its cash, and it eventually just, as Craig called it, self-implodes.
Yeah, and like you said, they don't do it when they're young. They do it when they're older, and it may be more difficult to replace that insurance at that point.
Right. That's where the hiccup is. So, universal life has a place, but you need to be very careful about the provider, about the company that you're dealing with. And like Craig said, it's like anything else. Just do a little due diligence in there if you're looking at it and going through it. The next one up is sort of, we move off of just the UL. It's still in the UL chassis, so same sort of concept. It's called an indexed universal life. And now what happens with an indexed universal life is that instead of that interest that's getting paid into the policy, you are choosing, much like a fixed annuity, you're choosing either the S&P or some index, the S&P 500 or some version of a market index that the crediting to the policy is then based off. And where this becomes a problem is there are costs. We've been talked about the cost of insurance. There are fees that are coming out of this policy. But at the same time, if there's no crediting, then where's the money coming from?
Right. It's the same thing as the first, but it gives you an opportunity to possibly have more growth in the policy because you're participating in these indexes, which is basically just like I said, the S&P 500 is an example of a benchmark. If it goes up by a certain amount, you're participating in some of that growth without any risk of the downside.
Right.
Right. So the issue is you're giving up that that dividend opportunity for the indexing opportunity. So this is something that may be a little more for a more advanced investor or a more advanced, part of your portfolio. But once again, it does have a place. It's just a matter of what you're trying to accomplish.
Right. And one of the things with this one and the next one we're going to talk about, is Craig meant that maybe a little bit more, involved, in terms of it, but it's also for somebody who's going to what we call overfund. Instead of paying the minimum premium in those first 5 or 10 years, putting more money into the policy, which is allowed to do, which just, it increases the ability of the policy running forever in that situation.
Yeah, the issue is, why would you overfund a policy? And there's lots of reasons, right? Do you want to give one, or you want me just to give a couple?
Well, so in the case of doing it, because what you're doing is, in the early years, the cost of insurance is less, so they're going to take less away from it. You're building up the reserve and the cash there. And as Craig said, if you are participating in the market and you're getting some boost or some increase, you're increasing more out over time.
Right. And also the additional funds you're putting in, you've already paid the cost of insurance and the expenses. So all that is going into cash value. And, life insurance policy, your earnings are tax deferred. So,
Correct.
So it's another way of putting away some money for those people too who can't do a Roth or some other account because they don't qualify. It's another way to put away money on a tax deferred basis.
Right. So it does allow you to do that, and you can add more in than you wish to. You have the ability to overfund. One of the nice things with both the universal life, the indexed universal life, and the next one we're going to bring in is they allow you to make, it's not a, hey, you got to pay this amount like term. I got to pay this amount every month no matter what. You can pay a little bit, you can pay a lot, you can use some of the money that's in the cash to offset it. It's flexible in terms of the premium payment scheduling that you can do with these policies. The problem is if you get, too much on that or underfund, you can run into the problem of not having the policy stay in force.
Right. So this isn't for the person who's running a strict budget who can't afford any
Yeah,
fluctuation, right? This is you have some extra money to play with and you want to get some extra value out of it.
Like Craig said, like one of the places this really fits is for those people who are, income out of a Roth. This is a nice way to fill in into terms of the Roth idea. So similar concept, but unlike the Roth, this gives you that, hey, look at it, if I passed in 2 years, my beneficiaries, my wife, my family are going to get a bucket full of money that I wouldn't have had if I just opened a Roth.
It's a self-completing Roth.
Yeah. All right, and then the next one is this crazy animal that's called, variable universal life. So variable universal life takes the concept of the universal life, the index, except for in doing it based on an index where you're just getting credited with either a cap or participation and you can't lose money. This is being invested directly into the market. We're buying mutual funds inside the policy and the market is doing whatever the market does. Excuse me for 1 second. That if the market goes down, the valuations of the cash value inside the policy go down. And comes to a point that, one of the dangers with variable universal life is that you can run into a margin call on your life insurance policy. Because there may not be enough money in there to offset what you're doing. So like Craig said, suddenly they're going to turn around and say to you, hey, I know you've been paying, $5,000 a year, but now if you want this thing to survive, you got to put another $8,000 or $10,000 into the policy because otherwise it's not going to survive.
Yeah, because the problem is a lot of times they'll do what's called a target premium, right? And that's enough premium to kind of get the policy going at a minimum. And
Right.
variable, they assume that you're going to get this rate of return that's going to cover the back end, the cost. The issue is if you don't get that return, like Tom said, and get margin called or pulled back because you still got to pay the expenses, you still got to pay the cost of insurance, then all of a sudden there's not enough there. And the target you were paying in to begin with 15 years from now isn't enough to cover the expense. Right. So once again, it can end up being something that implodes on you. These are very, very popular about 15, 20 years ago. But like a lot of things, they over positive what the rate of returns were going to be, over expected the rates of returns, and there'll end up being some issues with them. Now, the other thing is that sometimes there are other what we call riders or little add-ons that you can put in to guarantee certain things, but all those add to the cost and the expense, which can be a drag on the overall return. So
right.
A good fit for certain situations, but you just got to make sure you know what you're getting yourself into.
Yeah, well, the number one spot where this comes in is in executive bonus. Most executive bonus plans are done through a variable life chassis for the idea that they're overfunding. Again, that conversation of overfunding in those early or for a time period, 10 years, 12 years, whatever it is, and they're plowing a ton of money in, which offsets the risk of downturns or market turbulation or whatever the case may be.
Dependent on the growth, right?
Right. And then eventually the growth is going to kick off and go from there. But it's that you're overfunding in those early years. Yeah, because the same thing, same conversation like IUL with this, it's called BUL, that variable is that if you're not overfunding, it's really not worth it to you to be looking at. So that's the conversation. If you're somebody who's like, okay, I'm going to be plowing extra money in, they told me it was going to be, like I said, 4,000 or 5,000 a year. I'm going to put 8 or 10 in this year.
Right.
You may be getting a bonus from work or something. Okay, then it fits.
Yeah, where it doesn't fit is to go, well, the premium is going to be less because the income from is going to help make up the difference.
Correct.
I'm doing this on the edge, trying to get as much insurance as I can. And then you play it off and then you're in a position.
Yeah, you blow up. It will never work. You'll never survive on it. So just know that's not a fit for this. You're better off looking at either, the IUL or UL in that situation, or the next one we're going to bring into the conversation, which is the permanent of all permanent, which is whole life,
Mhm.
right? And whole life really is that whole concept, which is it's permanent and it's meant to be paid every month, every year, however it's set up, so that it doesn't ever blow up. There's never any, problems or worries or whatever the case may be. Same idea. You're paying a premium to the insurance company who's deducting the cost of insurance, but unlike a UL or any of the variations off the UL, which are reassessing the cost of insurance based on age every year, the whole life treats you the age that you were when you took the policy out.
Right. You're always that age forever.
You're always that age forever. So if you took this out at 35 years old and now you're 55, you're still paying the cost of insurance like you were a 35-year-old young chipper dude. Right? It's not like you're the 50-year-old, 5-year-old guy you actually are. So that's part of the benefit to the whole life chassis, to the whole life platform, that they allow you, that cost of insurance thing doesn't really play in like it does in a universal chassis. The other is that if you happen to take a loan, because it's building up cash value, just like a UL, just like an IUL, just like a VUL, they all build up cash, and you have access to that cash. Like we said, you can use that cash to offset future premiums. You can use that cash to, buy a car, pay for college, do whatever you want with it. It's your money, right?
Well,
You can do whatever you want with the cash that's inside the policy. You're taking it out as a loan, as sort of ramifications that go along with that. In the case of the universal chassis policies, that money disappears from the cash value. So the dividends, the returns, all of that is crediting, it's not there. In a whole life, they treat it like it's still in the policy.
Yep.
So if you had 50,000 and you lent yourself 20 or 25, they'd still be crediting you like you had 50 inside the policy.
Yeah, I mean, for me, Tom, I really like whole life insurance for solving that problem of making sure it's going to be there when you need it.
Right.
It's the Cadillac, in my opinion, of insurance. Now the Cadillacs are good cars again, right?
Yeah.
I
Getting there.
would say that in the 80s or 90s, but now they're back, and I would say it's a Cadillac of insurance. For all the reasons you just said. One, you're not taking the risk. The insurance company's taking on all the risk.
Yep.
You know exactly 20 years from now what your cash value is going to be, guaranteed, if you just make your premium payments.
Right.
You get dividends, it gets even better. But unfortunately,
right. So there's the conversation in that. So just to, bring the audience in terms of it. So what happens is, much like universal life, instead of an interest rate, what whole life does is it credits a dividend. Much like a bond, much like a CD or something. It's crediting a dividend instead of an interest rate. That dividend is getting paid out. Now, they're not guaranteed. You can't say, hey, that dividend is guaranteed, even though you've paid it every year you've been in existence, because they can't do that. But as Craig said, there's one thing to look at with any policy, and I didn't go through this, and thank you for bringing that up. That every policy will give you a ledger that has two different sides to it. Side number one is the guarantee. That's the charges, the crediting, all of that stuff. How long is the policy going to stay in force, and what's the cash buildup going to be like off the guarantees, which means the maximum they can charge for insurance and the maximum fees they can charge. And then the other side is the non-guaranteed, which is what the current market rates are and what they're currently charging, basically.
Right. And it's competitive with other life insurance companies as well, right? Because otherwise they couldn't sell their policies if they weren't paying competitive dividends. And to your point, yeah, I mean, if a company's been around for 125 years, they probably paid a dividend every year. But because dividends aren't guaranteed, they can't say they're guaranteed. And that's also because the state commissioners tell them they can't say they're guaranteed.
Right. Yeah. No. And that's part of the whole conversation there, is that, you have that aspect to it that you can't do that, as far as it, but you really need to look at, that's the thing that we suggest. Anytime you're looking at permanent policies, you want to look at the ledger and you want to look at the guaranteed side. Show me what the numbers are on the guaranteed size, because that will tell you the worst case scenario as what's going to happen. And if you're okay on the worst case scenario, then like Craig said, the other side just gets better.
Yeah, and I think the big thing too that scares people when they think about life insurance, they go, "Why would I buy this? It only helps me if I'm dead, and I'm dead, so it only helps the other
Well,
people."
we're going to get to that with the questions. We'll get to that
Okay,
in a second with the questions, with that whole part of it. But, same idea. So, again, it says you got fixed premiums, you get paid to the insurance company. It builds up cash value, which again can be used. And then there's a death benefit that gets paid out to your beneficiaries upon your death because it's permanent and it's always there. All right, so we move on to a little bit different version now, which is, group coverage. So, group coverage, these are, 99.5% of the time, that annual renewable term that Craig was talking about. That's what a group policy is. And all they do is take the census for the company and say, here's what the pool is. This is what we're going to charge you to cover all of these people for 1 year of term coverage. And it's usually either a base number, right, Craig, like $50,000 or, 1 or 2 times your salary.
correct. That's correct. And usually the company's doing a little bit of an offset, which makes it a little less expensive.
Right. So the 50,000 is just simple for them to calculate, but that's usually how a group coverage comes into play. Right. So you're covered. Usually the employer is providing this for you. It's paid for by the employer. They're giving it to you as a benefit. And you've got $50,000 worth of coverage or one-time salary, whatever that may be. And that's what you're getting. Mm-hmm. What goes from there, what moves with that then is a lot of times you get offered supplemental and or AD&D. And we're going to start with AD&D first because that's the fun one to talk about, right? That's more of the fun one. That is accidental death and dismemberment.
What?
And when we talk about dismemberment, we're just not talking about losing one thing. It's you got to lose a couple, basically. It's like multiple digits that have to go or things in terms of it. Yeah. It has to be accidental. And here's the thing with that. The number of deaths that actually result from an accident is very, very small. It's the percentage is like under like 15% or something, right? I mean, it's a very small number.
Yeah, and that's why this is so inexpensive and they give you so much of it for so little because they know it's almost statistically almost never paying out on this thing. Right. I mean, to lose it. I mean, unless you're working with, in an industry, maybe in manufacturing where you may have an industrial accident, where you might have both of them.
Yeah, then the whole hand goes in and the machine chops it off. Yeah, okay, that I understand.
Right.
But yeah, no, for the most part though, so AD&D, it's just usually an add-on. So sometimes they'll give it to you, sometimes they won't. Sometimes they'll say, hey, you can buy extra AD&D coverage to go along with the life insurance, the group term that we gave you. We don't recommend that. But if they offer you supplemental, that's something to be looking at because a lot of times they'll let you buy additional coverage, again, based off your salary, usually, to have as coverage. And again, it's based off a 1 year term policy, the whole census of the company. So usually it's fairly cheap in terms of the dollars. I mean, unless you work at a company with a whole lot of old people who smoke, you probably got a fairly reasonable rate for that.
Yeah, and the other issue too, like you said, Tom, is because accidents don't happen a lot. Let's say they give you a $50,000 as a group coverage, and then they're giving you $50,000 supplemental in accident. I would just consider that you only have 50,000 in coverage because it's so rare that someone actually would die in an accident. I say, if someone does die and has a stroke or heart attack, bring them up on the roof and throw them off.
Right. No. But the supplemental is regular coverage. They're giving you, that's what you're purchasing. The employer paid for the original 50. Now you're buying 50 or 100 yourself.
Oh, I'm just talking about the AD&D. I'm sorry.
Right. Yeah. No. The AD&D is like I said, if they're offering you AD&D, we generally don't recommend it because it's just one of those things that's like, okay, it's rare, so rare to have it happen, which is why they can do it so cheaply.
Right. And I'm not saying don't take it because it does, if it costs pennies, then that's fine. But that's
Right, depending on the cost and what that does and where it's at and that part of it. Right. Good point. All right. So questions that come up a lot, right? So the first one, do I need life insurance? Right. So, let's start there. This is like, do I need a will? Because it's a similar type of conversation. Like if you have somebody who relies on you in any way, shape, or form for expenses, maintaining the household income budget, whatever the case may be, then you should have life insurance. If you have children, you should have life insurance.
Mm-hmm.
If you have a beneficiary, a wife, kids, you should have life insurance.
Mm-hmm. Yeah, the other reason you may want to have life insurance is because you may have an estate you want to leave, right? So you may have, charities you want to leave money to. The other thing is,
Charitable deduction, do a nice job. Yes, charities.
yeah, and it's a great way to leave money to charities. The other thing is, it allows you in estate planning to leave your assets to a charity and leave the money in the life insurance policy to your heirs. Much cleaner way of doing things. And then
Right. And it also, like you just said, like in the case of depending on how much, the state of Massachusetts, the $1 million threshold isn't that high in terms of the state estate tax, that you can have that to offset the tax that's due at the time you die.
right, but the issue is if you leave all of your assets to a charity and then you leave the life insurance owned by a trust and that goes to your benefactors, then there is no estate tax.
Right.
Right. But the bigger part is because a lot of policies, and you got to look into this, have certain riders that add to your living benefit. One of them in almost everyone, especially in the state of Massachusetts, I don't know about every single state, is critical care, where it allows you to access a part of the death benefit for if you have an issue where you have two activities of daily living that you can't do, right, over a certain period of time. So you could access up to 50 or 60% of the death benefit. So if it was 100,000, that allows you access to 50 or $60,000 of cash money that you can use to help with your care.
Right. That's the end of life, that type of thing. When
A terminal illness rider as well. And even some of them have what we call disability riders, where if you're actually paying the premium, you can convert it and the insurance company will keep paying the premium for you if you're disabled.
Right.
It allows it to continue to build up cash value that you're not. So it's a
Well, that's if it's a permanent policy, and the term policy, they're just paying the term.
Well, it depends. Some of the term policies are automatically convertible.
Right, but some aren't. Right. So it just depends on what you're dealing with in terms of that.
You're saying there could be a lot of reasons why you could even need life insurance if you're single.
Correct. All right. I have coverage through my work. Isn't that enough? Well, here's the thing. We didn't talk about it with group because I knew the question was coming up. The problem with group coverage is that, again, 98, 97% of the policies, once you leave your employer, that policy ends. So you don't have coverage anymore once you leave that employment. There's convertibility. That's what's known as being able to take the policy with you. But it's very, very infrequent that the coverage for convertibility exists.
Mm-hmm.
So if you leave your employer, you don't have coverage anymore. And depending on the situation, like I just had a conversation with a couple today, like the individual's getting coverage through her employer, but it's 1 times her salary.
Right.
She's making okay money, but it's not great money. And it's definitely not enough to cover the need, like Craig said, because she has another 30 years to work. Like there's no way it's enough coverage. So I'm like, look, I'm going to tell you, this is something you need to be thinking about to do this, because that's not enough coverage for you.
Right. Okay, family, you're good for 1 year, but after that, you're on your own.
Right. Then you're on your own in terms of dealing with it. Does it require a medical exam? In most cases, depending on the amount of coverage, we'll talk about our offer in a second. But for most companies, if you go more than either 250 or 500,000, they're going to require, and as you get older, they are absolutely going to require a medical exam, having a nurse practitioner, drawing blood, all of that stuff comes into the equation.
Right. Yeah. The issue too is like you'll see lots and lots of commercials out there saying no medical exam required, no medical exam required. Because what they're doing is they're throwing you into a pool based on smoker rates, right? And you're paying a much higher, because they're assuming you're in the worst health possible, and you're paying a much higher rate because of that. And you also got to read the fine print too. In a lot of those cases, if you die in the first 2 years, all they give you back is your premium, right?
Yeah.
So you got it. And like I said, sometimes the cost of insurance per what unit, the unit being $1,000 of coverage, can be astronomical because you're not underwritten. So just want to be careful with that as well.
How much insurance should I have? That's another question that comes up. Like Craig said, a lot of that is based on, how long you're going to be working. Some of it's based on the liability issues, like you talked about, the debt. What are you trying to cover? You're trying to cover paying off the debt, trying to pay off, the kids' education. What are you trying to do? It's, everybody's got different parts, different variables to what they're trying to cover. So it's not an easy, steadfast answer because there are a lot of factors that go along with that.
Right. And some things that some people don't think about is, well, my wife was still working, so we don't need this much if I died, or my husband would still be working if I died. The issue is it's more than the value of what you earn. It's also what do you do at the home that now you got to hire someone to do. So there's additional costs for that too. The other thing is, there's an emotional impact. Some people can't go right back to work.
Yeah.
Sometimes they're taking care of things they weren't taking. So you just want to take all those types of things into consideration.
Yeah, no, and it's one of those conversations. Like if you have younger kids, it's like, well, okay, well, I'm just going to continue to work. The dads say that a lot. Like if she passes, I'm just going to continue to work. I'm like, yeah, who's taking care of the kids then? Right? Who's getting them ready and doing stuff and taking care of all that stuff? And it's like, oh wait, I didn't think about that. I'm like, yeah, you've got another, 7, 8 years before they become somewhat independent. To do that, you got to factor those costs in as well.
Absolutely. Yep.
How much will it cost? That's look, as Craig said earlier, the whole idea here is you've got to qualify for coverage. Mm-hmm. Coverage is all based on your age and your health. So if you are young and healthy, more than likely you're going to fit the best possible rating or a high rating available. If you're old and out of shape and not healthy and you smoke, all of a sudden the costs go dramatically through the roof. Smokers get hit with a 40 to 50% premium increase. So
it's also gender bias too. This is where women get a break, right? Well, coverage is cheaper for women than it is for men because they expect they're going to live longer.
Women live longer, they take better care of themselves. Absolutely. So it is one of those situations that does happen. Right? Mm-hmm. Why do I need it after I retire? Right? I got to the end of the line. I'm retired. The house is paid off. The kids are gone. Why do I need more insurance?
Well, sometimes when we look at insurance, it has multiple uses. But one of the unknown uses is how do I use that to have a better distribution strategy in retirement assets? And that's a whole nother topic for another thing.
Right, but that's the offset, right? Because that money, like you talked about, becomes like a Roth. That's my cash. I can now take that cash and there's no tax consequence.
Right. It also allows you to create retirement streams because you have something to replace income with should you be gone. It allows you to deal with estates. It allows you to leave money to heirs. It may have built-in benefits like we talked about with, disability or terminal illness or catastrophic care. So there may be a lot of reasons that it's very beneficial to have a policy after you retire.
And then let's face the one that comes up for everybody, which is final expenses, right? Burial, dealing with that there might be some debt that is also there. So there are a lot of reasons for it. So it's not just like, hey, I got to the end of the line, I'm done. No, there's other stuff that continues to go on. Depends on the age of you and your spouse. If your spouse is younger, like then what happens? So you got a lot of factors that you have to look at with that. All right, so this whole buy term and invest the rest, right? So this is something you may have heard, something you may have actually looked at or listened to at some point. I will tell you, my industry is responsible for this. The investment guys are the ones who tell you buy term and invest the rest. That's the whole idea. So it does a couple of things here. The first one is it presupposes that you as the individual are going to take the policy, the term policy out, and that it was going to cost you, say, $100 for the term, but it was going to cost you $500 for the permanent coverage. That you are then every month going to take the difference and be investing it in whatever mutual fund index, ETF that you're choosing to do on a regular basis. And from Craig and I, we know from experience that most of us do not follow through on that and continue to do it. So there's the one fall down with that. The second is, depending on when your timeline ends, like if it ended in the beginning of 2022, you would have lost 20% of your value at that particular moment in time. And if you died at that point, there would be 20% less in your fund than what you had when you started. And there's no way to guarantee that the money's going to be there.
Let's be honest, Americans are notoriously bad at saving.
Correct.
Right. And we're notoriously bad at saving on a regular basis. So in order to do buy term and invest the rest, what you're basically saying is the money that I would have put into the permanent policy, I'm now going to take and invest on regular intervals every month, like I would have paid my premium, and do that. That doesn't happen. But
right.
We
doesn't work.
want to say we're going to be the exception. We're not the exception. No one's the exception, right? We all say we're going to be, but we're not. And so now we get 15 years down the road, plan didn't work out the way we wanted, and we're like kicking ourselves, saying, well, geez, that didn't work out how I wanted. And now my term insurance just ended. Now what do I do?
Right. Now what do I do? I don't have anything. I don't have any cash build up. I got nothing. What am I doing? So there's a lot there that goes awry with it. So you just need to be wary of it and be thinking about that when anybody says it to you or looks at it and say, wait, can I base this? Let me look at some of the numbers here in terms of going through it and figuring that out.
Yeah, the other thing too, a big thing, Tom, I find with this is when you're buying life insurance, you're looking for something that is guaranteed. You're looking for something that's going to be there if you're not.
Yeah.
By taking
That's the end result of it, the whole idea and the whole premise is that it's meant to be there when you pass.
So the issue becomes when you start trying to invest in difference or, shaving it this way or trying to make money to offset the premium, you're taking risk.
Yeah.
What you're trying to avoid with insurance is avoiding risk.
Right.
It's there in case risk happens, you're not trying to create additional. So that's just something to take into consideration when you're looking at the entire picture.
Right. Absolutely. So our offer to everybody, and one of the things, if you're curious or want to know, one of the things we can do is ARIES has the ability to have you just click on this link. I don't know if you got it, Craig. I sent it to you. If you have the link, you can drop it in the chat box.
Oh, I don't know if I have it.
I sent it to you, but I texted
I'll
you.
drop it in.
Okay, but anyway, it's right there on the screen. If you want to copy it, or if you see it, you can just copy and paste off of that. What that does is it allows you to go in and 5 minutes, you answer a couple of questions. There's a couple of knockouts on this whole non-medical thing, but it'll come back and say, hey, based on that, you would qualify for this amount at this price. So it just gives you a ballpark to say, here's what the cost would be. Because I know that's one of the things for everybody. They're trying to figure out what is the cost of insurance going to be. Well, this is a tool that'll allow you to do that, and it's an offer. So if you said, hey, I want $250,000 of coverage, and that's a good price, I'm comfortable with that, you can just click on it and you can walk through and get yourself a policy. But it'll at least give you the idea and the concept of what the cost would be. And then the conversation from there, if you ever want to reach back to us, we'll talk about that in a second. We can then walk through, hey, here's the offset versus what it would be. That's non-medical term. Like Craig said, this isn't that throw you into a bucket a whole bunch of bad people. This is actually getting you a preferred rating if you qualify for that type of thing.
Yeah, and you make a good point, Tom, is that not everybody qualifies for life insurance. So it is kind of a privilege when you can get it, and you want to make sure you take advantage of it if you can.
Right. Yeah, and one of the things we try to do with everybody is try to help them get that clear understanding. Like I said, in this case, it's kind of seeing what that ballpark is, where you would be or what the cost would be. Because we know that's always the first question that comes up is, what's it going to be? What can I get? What's the cost going to be for this if I wanted this much amount? That's one way to do it. The other way we do it is we walk you through the whole process. Craig and I developed this thing, we call it the Roadmap to Financial Awesomeness. But one of the tools inside there talks about loss of life and what that calculation would look like. What are you trying to cover? Like we said, there's a whole bunch of different factors, right? There's liability, there's length of earnings for your human capital type of thing, education for the kids, if that's in the equation. What are you trying to cover? How much do you need? And what is that going to look like?
And if you have a child with special needs, it may be a whole nother category.
Now you're into a different conversation. That'll be next week's. We'll talk about that in a second, right? In terms of going through that. But all you have to do is type yes in the chat box if you want us to reach out to you. Craig has a schedule. He's probably dropping it in the chat box as we're speaking, where you can just click on that schedule and absolutely set up a time. Happy to answer those questions. Or if you went through the process and now you have questions about, hey, what it would cost me for a permanent policy, we can do that for you as well. This is Craig and I in our more formal attire. Yes, we know the TB12 jerseys, and now he's absent from Tampa Bay practices, and he's not going to be back for at least another 2 weeks or some craziness. Who knows if he's even going to play this season?
Oh, he's not even started? Is that the case now? He's not even starting the season?
No, so he's taken personal leave. They were expecting him back, and now he's not going to be back until after at least the second game, if not the third game of preseason. Like, he's not going to play any preseason, basically.
So Giselle is mad at him for something.
Yeah, there's some craziness. But anyway, all right. So we keep Think with a Drink going with what's on tap. And, Craig sort of walked into it a little bit there. Next week, we are doing funding a special needs trust. That's with our special guest we have with us from the Plan of Mass and Rhode Island. They are a pooled trust provider. So happy to be, if you got somebody who has a child with a disability or who's differently abled, I suggest that you get them to tune in, because we'll be talking about all the different tools and ways you can fund a special needs trust. On September 1st, we're going to do Beneficiaries Are Important and why you need to be thinking about them and reviewing them and all the different aspects of that. And then on 9/8, it's Recession is Coming. The recession is coming. We don't know if it is or not, but we go through some of that.
We'll ring a big bell while we're saying it.
Yeah. Craig, any questions in the chat box?
I have no questions in the chat box.
All right, we're right about up on the hour, so I'm just going to say, if you do have any questions, please feel free to reach out to us. You can visit the website. It's www.ariesfoundation.org. There is a contact us, right on that page that you can reach out, ask a question, or you can just shoot it to our inbox at info@ariesfoundation.org. And I'm going to say on that for everybody, have a great evening.